All right, well, the time has finally come. It is time to record the options masterclass. I threw together a video not too long ago. It was called sort of the charting and options masterclass, and I feel like it covered everything that I wanted to discuss in terms of charting. However, there's more that I think can be said about options. Essentially, in that video, and I'll link it down below in case you'd like to go check that out, I gave what I find to be the absolute basics of options. Well, fear not, as your knight in absolutely no armor, instead just a limp dong t-shirt, is going to walk you through what I believe to be the most important aspects of options. Obviously, at the purpose of saying I'm not a financial advisor, I'm not financial advice. Please take what I say with a grain of salt. Do your own due diligence. Fact check me, back check me, whatever you got to do, right? Do your thing. But this is going to be everything that I find to be pretty valuable. So let me give you a brief introduction into what we're going to be discussing today, because this is going to be a long video. It's going to be chaptered out. There's going to be lots of good content in here, starting from the absolute basics of options to what I find to be solid strategies of options. So here you can see on the left side in red that I've got levels 1 through 4 of what we're going to be covering today. The basics, the shit people hate learning, long versus short, and then finally, strategy, what I find to be decent strategy. We're going to dive through each individual piece of this one bit at a time. But like I said before, if you'd like, if you want to sort of skip through stuff, feel free to just do so. I'm not going to take the time to edit this. I don't think this is a video meant for editing. I think this is one of those ones you do off the cuff. So let's just begin. Let's start off with level 1, basics of options. And I think the most important thing that we can do, and if we're going to talk about options, is first off, talk about the risks of options. In fact, there is an infamous page which is literally dedicated to the risk of options, and that is last porn on Wall Street bets. This is something that if you Google, you're going to find lots of degens out there who've got the itch for gambling, probably the same as many other people on planet Earth, will piss away hundreds of thousands and millions of dollars. For every person who, on the flip of a dime, turned 10 grand into 10 million, you've got a guy who turned 111 grand into 3,000. The long lost secret of Wall Street is if you want to become a billionaire, first be a trillionaire and then lose a couple $1 billion, or vice versa, $1 billion down to $1 million, whatever. Make sure you start with extra. And the point of this is it's very easy to lose money on options if you don't know what you're doing. So the first thing that I would tell anybody is to learn, to practice, and you can do this in a paper account. There's lots of brokers out there that will allow you to do this, and then to try executing. It's always good to start off small. It's always good to sort of gauge yourself and your risk tolerance and learn about the way that you would like to personally trade. And here's just a couple examples of people who did not do that. And I just pulled some images off the internet. This guy lost 99% of his port value. This guy lost $30,000 down to $2,500. This guy, which I just showed you straight from Wall Street Bets, lost $111,000. And this screenshot right here, for full transparency, is a loss that I have taken in the past due to poor risk management. This was on Moderna. It was a $41,000 loss, and I actually happened to be green on this trade before I closed it out for that $41,000 loss. It was a rough day. I mean, to say the least. Bad trades happen, and you can avoid these bad trades by taking good risk tolerance decisions, which we are going to be talking about. We're going to dive into all that sort of stuff as we continue on. But I think I'm doing you a disservice if I say anything other than that trading is risky, trading is hard, and that you are likely destined to be a statistic if you don't take the time to actually learn. Successful traders are successful because they've spent hundreds of hours, thousands of hours practicing and honing their craft to adjust with the market and to beat the market. It's a difficult thing to do, and I want to make that painfully clear before we even begin. So the takeaway from that, options can be risky if you don't trade with a plan. However, right now that I've shown you that this can be risky, there are ways to avoid that risk and actually take less risk, believe it or not, than if you were to own stock in, let's say, Tesla, or maybe it could be like a vaccine play, it could be a pharma play, it could be a one-off squeeze play like PPIG or Mullen or this or that, or I know I'm going to get people in the comment section that say, Trey, please, don't say that. But you get my point, right? I'm using examples. Options can be less risky because you're putting up less money overall than you would have to with a share. Now, I'm going to get into why that's the case. So to start off with, what are options? To put it the most simple way possible, there's two possible ways that I think you can look at this. And it is that options can either A, be a leveraging tool, or B, they can be a hedging tool. Now, why would an option be a leveraging tool, right? Well, if you have to break this down in the most simple way possible, one contract, whether that be a call or a put, and I'm going to get into this more as we continue on, is equal to 100 shares, right? So let's say that I wanted to take on a 10 contracts on the $10 call for XYZ stock, right? What that would mean then is if one contract is worth 100 shares, I am actually working with about 1,000 shares of total leverage. That's a lot of leverage. You're able to put up far less money than if you were to actually buy the 1,000 shares. For example, I'm just going to work with one contract here. Let's say that I was looking at Tesla right now, and I wanted to buy a 15 July 2022 $1,050 call, right? If I wanted to actually purchase 100 shares of Tesla, it would cost me a lot of money. 100 shares of Tesla times $1,050, you can kind of do the math here. It's substantial. I mean, it's a lot of money. You're putting up, it'd have to be close to $12,000 to $15,000 versus this option right here, which is $111, comes out to about $11,000. You're saving a couple $1,000s, and that's on a further out expiration. If you were to use a shorter expiration, you're going to get a whole different sort of metric. In this situation, if I wanted to buy one contract of Tesla for a call, that would be $24.15. You multiply that by 100 shares because there are 100 shares per contract. This is sort of giving you the price you're paying per share on that contract, right? That would come out to $2,415 to essentially have the same leverage power of 100 shares of Tesla. That is a lot of leverage. You're able to do so, right? This is sort of the leveraging example. The hedging example is if you were to use a call or a put to hedge against another position. If you were to hedge against inflation, some people say you should buy gold. Some people say you should buy Bitcoin. Some people say you can't hedge against inflation. But nonetheless, there are ways that you are essentially trying to protect yourself from inflation. So you can think of a hedge, if you were to use an option as a hedge, as a protection against something in the market. An example could be something as simple as if I was to scroll, over here ways and just draw this out. If I wanted to hedge against, let's just say, a long position, right? Let's say that I'm long on Tesla and I'm a little bit nervous. I'm looking at the stock and I say, you know what? I think this might go down for the next 2 or 3 weeks. And I have, 100 shares of Tesla. I'm a big dick Daryl. I'm rocking a lot of freaking shares. If I want to hedge against that 100 shares, what I could do is go long on a put. And what this is doing for me is saying, look, if this goes down, I am able to protect myself from the downside, right? That put is going to offset some of the losses that I have on my 100 shares of Tesla. And then if it doesn't, it doesn't actually end up going down, well, guess what? You don't have to put up that much money for this put in comparison to what you're going to make on the 100 shares that you own. If it does go down, you happen to make money on that downside, which you can then cash in and then either A, buy more stock, or B, just sit on, whatever you want to do. I mean, if you're a long-term bull on Tesla, you think 5-10 years from now, you'd probably want to buy more. But if not, it's up to you. You got to do what you got to do. That would be an example of a hedge, is protecting yourself from the downside. You can do the same thing for the upside, right? If I was short on Tesla, I don't know why anyone would ever want to fucking do that, but my point still stands. If I was short on Tesla, 100 shares, and I thought, you know what, the next 2-3 weeks look pretty bullish, I could go and get one long call to hedge myself against the upside, essentially offsetting any sort of losses I may accrue as a bear on Tesla, right? It's just a protection. It's a way to say, you know what? I'm not 100% certain that the short term looks good or the medium term or the long term looks the way that I think it's going to go. So I am going to hedge against that position by the off chance that I am wrong. It's a protection. Typically a hedge takes away from, the total you can make in the grand scheme. Like, for example, if I bought a hedge on Tesla, but the hedge ended up being worthless, well, you're not going to make as much, obviously, but it is a protection. Think of it as insurance. You can use options as an insurance plan, sort of to back up in case you think your dentures are going to fall out and you need a new pair of dentures. If you're to apply to the stock market, you know, it's just saying like, yep, if this is wrong, if I happen to be in the wrong here, you happen to be protecting yourself. You bought that insurance. So now that you can kind of think of it in these two sort of ways, you can break it down from there. Leveraging is more of a trading thing or an investment thing. Hedging is an insurance. Think of it as two separate things: investing or trading, or an insurance policy. That's kind of how you can view options in the really sort of macroscopic lens. From there, we got to dive into the next thing, risk, right? Now, the risk of options is actually pretty fascinating because it can either be a really risky sort of tool that you use if you are not using proper risk reward and strategy and having a plan going into a trade, or it can actually alleviate risk. You can actually do that. And what I mean by that, very simply put, let me come over to just an empty part of my screen right here and draw something out for you, right? If I wanted to buy 100 shares of Tesla, what I am doing is putting up nearly $10,000 right now, right? Tesla's very expensive. It's not a cheap stock. And if I go down, let's say 5% on my overall position, well, then I lost a pretty good chunk of change off of $10,000. The adverse to this would be if I don't want to put up $10,000 of risk to my investment, granted that investment stock cannot expire worthless, right? Contrary to a call or to a put or to options, what I can do is pick up a call or a put, which is far less money, as I've just previously showed you, than stock would be. And Tesla's sort of an expensive stock to use as an example. Usually whales are sort of trading Tesla. You have to have a pretty sizable portfolio. But if I wanted to go buy a call for this week to put up that $10,000 trade, instead I could put up 2,400. 2,400 looks a hell of a lot better if you have a good risk tolerance plan than 10,000 does. Now, keep in the back of your mind, obviously, that $10,000 is going to price a heck of a lot differently than this 2,400 is going to, but you can actually avoid additional risk if you're willing to stick to sort of a plan. Now, I'm going to give you a cheaper example of what I mean by that. Let's just go over to Apple, because Apple actually has some pretty decently cheap contracts. If I pull up Apple right now and I also look at the 14 April, what you're going to notice is you can put up $1.18 per share, which comes out to $118 a contract for the 172.5 strike. This is actually a very decently reasonably priced sort of contract in comparison to buying 100 shares of Apple at current market value, which is $170. If I was to buy 100 shares at $170, that is drastically more expensive than buying one contract, which represents the same amount of leverage for $118. The difference would be if I was to multiply 100 shares of Apple at $170, you're going to get zero. Fuck. It's been so long since I'm just going to do this the easy way. Guys, in the comment section, be nice to me, all right? I'm not a math guy. I went to school for nutrition. But nonetheless, you're putting up $17,000. You're putting up a lot of money, which means that I was actually probably in the wrong ballpark with Tesla. It would have been 100,000, but the point still stands. I'm putting up $17,000 for 100 shares, right? 17,000 here versus the contract, which is 118. You see what I'm saying? And now if I was to take that same math and you apply that to Tesla, right? Right now, let's just say it's trading for $1,000. I multiply that by 100. You're putting up 100 G's for 100 shares of Tesla. That is a lot of money. It's a lot of money, right? So if you're putting up 100 G's for that, and then you come back to sort of, the call chain for Tesla, you're putting up 2,400 instead of 100 G's, you can see what I mean, right? You're putting up a lot less risk if you can manage that risk accordingly in terms of actual dollar signs. So I just wanted to make that painfully clear that you can avoid risk if you want to take a very steadfast and trader/investment approach, right? Not gambling, but trader/investment. Next thing I want to talk about is the bid and the ask. Similar to stock, actually the exact same as stock, options have a bid and an ask. You can think of these typically as a bid and ask spread. There is a difference in the pricing between these two things. And whenever you think about it, ask, you want to slap it. You like who doesn't like slapping ass, man? If you say ass is ask, right? You want to buy the ask. You want to slap the ask. That's typically what you mean by buying. Bid would be obviously the opposite of that. A bid is going to be the sell, and this is the exact same thing as stock. There's not much really more to dive into on this until we get to the bid and ask spread, which is going to be later as we dive more into sort of the mechanics of options and what I personally am watching for when I want to buy a call or a put or some form of a derivative, which is what options are considered to be. That brings me into the differing price factors. There are a lot of things which we are going to dive into as we continue on that price in options, the way that these things price. Stock is simple, right? Stock, if a stock goes up, you make money if you bought it. If a stock goes down, you made money if you shorted it. That's not quite the case for options. Options are a bit more complex than that. You can look at options and say, as a whole, most of the time, if you bought a call and the stock price goes up, then you make money. As a whole, most of the time, if you bought a put and the stock price goes down, you make money. But it's not that simple. We have to make sure that there is that differential, right? Stock price going up or down does not always reflect the value of your call or your put. We are going to discuss that as we sort of continue on. This is going to bring me into the next sort of thing that I'd like to discuss. We've got a lot of different things in this first category that we're going to go over. We're just going to include where do options come from, who writes them, how does that process work, the value of options, which is going to bring us into a couple different terms, and then we're going to get into I choked on my spit. The takeaway of options overall. Let's first dive into this. Where do they come from? Where do options come from? Market makers. Now, market makers, I'm not going to dive into the ethicality of market makers. I could go on for a very long time about how I fucking hate these people. But at the end of the day, these guys handle your options contracts. They write them up. Most of the time when you buy or you sell a call or a put, either long or short, which we're going to get into as we continue on, market makers handle these sort of transactions. So in the most simplified way possible, there are extra steps that sort of dive into how a contract is written up and sold and this and that. But from the most simple sort of perspective, if you want to buy or sell a call or a put, you send this order into your broker, right? Over here, I've got Webull as an example, but you can use Robinhood, Webull, Thinkorswim, TD Ameritrade, Interactive Brokers. There's tons. I mean, you can basically walk outside and all the wrappers you see, flying down the road, candy bar wrappers. That's going to be the equivalent of how many brokers there are. You send that order to your broker. That broker then gets that order filled by a market maker. This market maker will fill that transaction, and you can think of this very simply put. For every sort of buy order, there has to be some other half of the trade, which is a sell order. So the market maker is writing up these contracts, and if I was to buy a call, that means that they sold me that call. If I'm to sell a market maker a call, that means that they bought that call. Somebody has to take the other side of that trade. And the other side of that trade is always going to be the market maker. Not always. I'd say 9 times out of 10. Sometimes it's retail. Sometimes you're selling back and forth to retail. But the market maker at the end of the day is who is handling those transactions. So you buy or sell, broker sends the order to the market maker fills the order, brings that back to the broker. You receive that order or whatever you want, right? If I wanted to buy a call, then you give them that money. They send you sort of that call. You get that transaction. If you wanted to sell, same exact thing, right? It goes both sort of ways. Which brings me into how to access options and the different level types of options. Now, I think most people will take a pretty basic approach to options, and I don't think that's inherently a bad thing. Over complexity is almost never a good thing. I think that there are people who try to use super advanced sort of option strategies, and in reality, sometimes don't know what the fuck they're doing. Right? I think that's the honest to God truth. If you're part of the 0.01% of options traders who has mastered everything, and you know the exact best sort of strategy. I mean, what I would compare this to is like speed cubers, people who solve Rubik's cubes insanely quick, right? What these guys can do is look at a cube and say, based on where every single square is right now, I have like 1,000 different algorithms memorized to spin the cube in whatever way that I want. That is sort of what I would expect for people who want to use all of the different option strategies that exist. There's a ton of them. I'm going to go into later the ones that I find to be the most important, the most useful for the most basic level. But how do you access them first in the first place? You have to request options from your broker. And there's different levels and types. To be frank, quite frank with you, when I got mine, you can read between the lines here, right? Sometimes they ask you questions, and it's up to you to decide to be truthful with those questions. So you got to first request it from your broker for Webull, for Thinkorswim, for Robinhood, for interactive brokers, for this, for that. You can call them, or there's typically a form online in which you have to request options. And based on your experience level, based on your income, based on how long you've been investing, they will assign you or deny you based off these 4 levels. Level 1, which is allowing you to write covered calls and protective puts. Level 2, you can do all of the above and buy calls or puts and open long straddles and strangles. And essentially what this is saying, write covered calls and protective puts, is to sell a call and sell a put. This is a covered call is to sell a call, a cash secured put or a protective put is to sell a put, right? These are the most basic and typically the most risk adverse sort of options. Level 2 is long calls, long puts. This allows you to buy a call, buy a put. You would be on the opposite side of somebody selling you a call or selling you a put. Level 3 and 4 get into more complex sort of strategies. Level 3, you can see you can do all of the above and open long spreads and long side ratio spreads. Level 4, you can do all of the above and use uncovered options, short straddles and strangles, and uncovered ratio spreads. I'm not going to spend a lot of time on level 3 and 4 because these are more of the advanced sort of subject matters that I think is, like I mentioned before, the 0.1% or the 0.01% of people who know all the algorithms for every single scenario that makes sense. I think that most of the time you can get by very easily by having a good risk plan and by having a strategy, and that's really about it. I was trying to get a third thing here, but I really don't think there is one. So from there, where do you buy them? I've got an example here. Check this out. These are things that I find to be important anytime you're looking at a call or at a put. You can see that I've got calls and puts up here on Webull. For your broker, it's going to look different, but these are the things that you're looking for to know where you can buy them, right? If I wanted to buy, for example, a put, what I'm going to be looking at is the strike, which is the price in which I have interest in for either the call or the put position, the expiration date, which I also have in white right here, this example being 14 April 2022. And then I'm going to look at the bid, and I'm going to look at the ask. As I just mentioned before, you slap the ask anytime you want to buy something. You hit the bid anytime you want to sell something. If I wanted to buy a put, I would come to the ask, which is this white square right here. And if I wanted to buy a put for $13, the expiration date of 14 April 2022, I would hit this right here. I'd hit this button. I'd hit that 5-cent ask. And I would then have, if I have $5, because 5 cents times 100 is $5, I would then have one put for $13 available to me. That would be available. You can be able to see that and say, yep, that does make some sort of inherent sense. If I want to buy a call, it'd be the exact opposite. I just click on call here. I look for an expiration date. I look for a strike that interests me. And then I would buy that call for whatever the ask is on the day. When you go to sell, right, either a call or a put, if you went long, you have to hit the bid. The bid is what you are actually going to receive after you sell that contract, which you can see here is different than the ask. And we're going to get into this more as I dive into sort of mechanics and strategy behind what makes sense to me with options. But this is sort of what this looks like and where you would first off buy them. We kind of already went over the advancement levels and what this looks like, which brings me into next sort of some terms that I would like to discuss and the value of options as a whole. After that, I'm going to talk about market makers a little bit more because this is going to have some inherent value. And then the takeaway. So in the money, at the money, out the money, and extrinsic and intrinsic value. If you got to watch this a couple times, that's okay, right? That's perfectly fine. But I'm going to show you an example of what this actually looks like. In the money, at the money, out the money, to put it in the most simple way, mean the following. In the money, which is a term we're going to use quite frequently throughout this video, is referring to a strike price that is within the either call or put range already hit. And what I mean by that, and I'll draw this out for you. Let me refresh my page real quick. It's lagging just a hair. What I mean by that, very simply put, right, is if I have a put, for example, I'll give you both calls and puts and what this would sort of look like. And I'm looking at a chart, and I can see that the chart is showing me that, let's just say it's Tesla, right? Tesla right now, I come back to handy dandy Tesla, and I'm looking at this, and it's showing me that the price is $1,025. In the money for this, if I was to buy a put, would mean that that strike price has already been hit, right? What would that mean then? If I want the price to go down as a put, that would mean that it is above the current price of $1,025. So in this example, if price is $1,025, a in the money put would be above that price. The strike price could be $1,030, could be $1,035, anything above, right? These are all in the money. The opposite of this for calls, an in the money call would be below the current price. $1,025 current price on Tesla. In the money call would then be $1,020, $1,015, $1,010, $1,005, $1,000. These are all in the money, and these are thought of as sort of the least risk associated for a call or for a put. At the money is super simple. The next term, which is at the money, is when strike price equals actual stock price. So at the money call or put, both would be the exact same, would be buying a call or buying a put at the current stock price of $1,000. Call or put. Easy, right? Last term is going to be out the money. Out the money is when you have a call or a put that has not yet been hit yet for the specific stock. So if I was to buy, for example, an out the money call on Tesla, right? I'm looking at this and it's at $1,025. That would mean that the strike price is above the range that has already been hit. Because if you think of it in terms of calls being bullish, if it's at $1,025, it's already hit $1,020, it's already hit $1,015, $1,010. It has not quite yet hit $1,030. This would be considered out the money. Anything above $1,025 for calls is out the money. For a put, anything below $1,025 would be considered out the money. Out the money. For example, 1,020, 1,015, 1,010, 1,005, 1,000. These have not yet been values hit for that designated strike price, making it out the money. This is considered to be the most risk high sort of investment or trade or leveraging tool or hedge, whatever you want to consider it, for a call or for a put, right? Calls obviously meaning stock price you want to go up. Puts obviously meaning long anyways, both of these, that you want the stock price to go down. So far, so good. That brings me into then extrinsic versus intrinsic value. These are actually going to be very important. And I think the best way that I can put this, I read this once and I found this to be pretty useful. Extrinsic value equals time. And this is going to make a lot of sense as we dive into the Greeks, but you can think of extrinsic value as something that may not come to fruition. The value in extrinsic value is that you have a lot of time for something to come to fruition. What do you want to come to fruition? Intrinsic value. Extrinsic value is the time allotment that may allow you to have intrinsic value. Time eventually passes, which means that you lose extrinsic value. Intrinsic value happens if or when or already, it depends, right? When the strike price has been hit. You start to accrue intrinsic value when your contract may actually be worth selling 100 shares or buying 100 shares, all this stuff we're going to get into as we continue on. I have this in far greater detail when we go down. But the intrinsic value comes from the actual value of the contract and not from time. Simple stuff, baby. Let's go on. Let's go on. There's one other thing I think I wanted to add to sort of this little part right here. I don't think so, but we'll continue on anyways. We're going to market makers. Check this out. Market makers and then the takeaways from this level one, and then we can move on to the next piece. Market makers. As I mentioned before, these guys manage orders, but I want to dive a little bit deeper into this because this is going to help you sort of visualize a strategy later on in the video. So if they're managing orders, that means they're a business, right? Market makers are there to profit. They're there to make money. They're there to essentially pay employees and pay themselves. Fair enough, right? That's a pretty easy thing to accept. So how do they do that? How is the how behind that? They like to collect premiums. The reason that I bring this up, collecting premiums, is this is going to dive into something that I'm going to discuss later, which is called max pain. Max pain is a theory that's really not a theory. It's just kind of proven by mathematics and by algorithms or whatever. By collecting premiums, these guys designate max pain, and from that, they want to have contracts expire worthless. What does this sort of mean? So if you were to buy a long call, buying would mean that you have a long position. Buy a long call or a long put. On the opposite side of that is the market maker who is selling contracts, right? Most contracts expire worthless. This comes back to what I mentioned before. Loss porn. It's very easy for people to blow their entire accounts if they don't have some sort of risk assessment, some sort of risk plan, avoiding the dangers of what can be a really bad thing, right? But they want to collect premiums, and how they do that is by expiration on a contract coming to fruition. For example, if I had $1,000 put on Tesla for this next expiration date, right? But it doesn't happen. Tesla doesn't close beneath $1,000. That expires worthless. Every dollar that I pumped into this vanished. Thanos snapped. Fucking dead. Where does it go? Market makers. These guys collect that, right? I bring this up because it's drastically important, and this actually affects the way that sometimes options move and the way that you're going to pick an option. This dives into things such as implied volatility, historical volatility, differing prices for calls and puts. There's a great example right now that exists that I'm actually going to go over, but they don't actually pick a side. Let me make that painfully clear. They favor, these guys want to make money on the most profitable side of either calls or puts. We're going to dive into more later, but I wanted to just kind of dip your palate in the taste buds of Diet Coke so that you can get ready for the sweet, succulent milk that is going to come later on. That is sort of the big takeaways from the level one, which is the basics behind options. We dived into the risks behind them. We've dived into sort of the different level complexities. I'm going to focus primarily on level 1, level 2. I think these are the best for the majority of people. And if you have an interest for more, I am confident that you are going to be able to learn about it on your own. We've talked about how it's like leveraging shares. You're able to put up far less money for the exact amount of leverage in a position, right? And then the value system and sort of, how these can move based on different price factors, which is actually what we're about to discuss next. So clap yourself, pat yourself, do whatever you got to do. We're about to dive into sort of the next part of the course, which is level 2, the shit people hate learning. And let me tell you right now, right? The reason I have not made this deep of an in-depth options masterclass yet, to be completely honest with you, is because people hate learning this shit. This stuff is boring. It's not fun. It's mind-numbing. When I learned this stuff, I had to sit down and bang my head against the wall for hours and hours and hours and hours because I didn't feel like anyone broke it down in a way that made sense to me. I'm going to do my absolute best, but I'm going to be straight with you, right? You're probably going to have to watch this section of the video if you do not understand it more than once, because that's what I had to do. I had to. When I was learning this stuff, I had to sit down and watch the video 5, 6, 7, 8 times because it is a complex concept. But let me make this perfectly clear, right? If you want to make money on options, if you want to make money trading, if you don't want to be a statistic, that's what it takes. Genuinely, you just have to understand how things work or you are most likely going to lose. That's something you have to accept. That's the truth, right? So let's start off. Let's just dive right into this. How do options price and move? There's sort of two overlapping factors in which you can see how options will get priced. And like I mentioned before, options aren't so black and white that stock goes up, you make money if you're long, stock goes down, you make money if you're short. There's other things that sort of move the price. And those things that I find to be valuable are IV, which you can think of as implied volatility, and the Greeks. Essentially, it's a representation of the Greek alphabet. There's different letters that mean different things. You can see this down here, right? The option Greeks. We're going to dive into what I find to be the most important, probably the most worthless as well, but that didn't really matter at the end of the day. But we're going to dive into that as we continue on. For now, let's focus on implied volatility. What is implied volatility? What does this mean in the grand scheme of things? Implied volatility, in the most simple metric possible, is when a market maker, which we just mentioned before, believes an option, or a stock more rather, a stock will go up or down in a given year. So if there's an implied volatility on a stock, we're just going to use an example right now. We're going to come over here to Apple, and I'm going to look at the implied volatility on the 14 Aprils, right? What you're going to see is the implied volatility is 24%. If the implied volatility is 24%, that means that options market makers believe that the stock price will go up or down 24% in this given next trading year, meaning that 1 year from tomorrow, they believe that the stock price will go up or down 1 year. That is a representation of how they're going to price the overall contracts, either calls or puts. Sometimes you will find imbalances on the calls and puts. We're going to dive into that more as we continue on. But these implied volatilities to me are based on two things. They're based on volatility. I mean, volatility is in the name, implied volatility. So it makes sense that volatility will play a factor in how implied volatility is sort of moved around and priced, which obviously affects how much you're going to pay for your contract. There's also demand. And I think the best overall way to measure demand is by looking at open interest. Now, if I'm to come back up and show you guys this really quick, open interest is a metric that gauges how many contracts are currently being held, either long or short, meaning buy a call or to sell a call, buy a put or sell a put. That's all measured. It's measured. You can keep track of that, and you can look at it by looking at the overall open interest. Now, what is something that you notice here, right? Check this out. This contract for $17 puts is 117% current implied volatility. It's actually a little more expensive than this one, right? 116%, 4,000 total contracts open. What about this though? Check this out. 116.42% implied volatility, which is actually further out the money. Remember, we just mentioned out the money before. It's further out the money, but it has an overall higher implied volatility. There is also more total open interest. Obviously, as you continue further and further and further out the money, you're going to have a higher implied volatility in both directions, both calls and puts. There's going to be a higher overall implied volatility. However, that is a metric that you're going to notice is that when there is more overall demand, when there's more open interest, that is going to affect the implied volatility. This is one way that an option can get priced. We're going to dive into the specifics of this as we continue on. That's actually going to dive into historical volatility, which is a sort of a strategy that I find to be useful. But before that, let's dive into these things. So what are IV pumps? What are IV dumps in the open interest, right? I think there's ways to protect yourself from Twitter scammers. I find this happening all the time. It pisses me off. This is sort of my PSA. IV pumps can happen when one of these two things change, right? So if demand goes drastically up, a pump is obviously when something goes up. If demand changes for the upside or volatility changes for the upside, meaning that there's more volatility or there's more demand, you can see something happen that's called an IV pump, in which a market maker will temporarily push the implied volatility up on an option. You can actually benefit from this. If you catch an option before an IV pump happens, maybe the stock barely goes up. It goes up 1%, but that percent happened really fast. They pump the IV and you can make a shit ton of money. It can actually be good. It's actually a strategy that some people use on Twitter to scam their followers. IV dumps are the exact opposite thing, right? So let's say that you bought at the top of that huge IV pump, demand went way up, volatility went way up, and then all of a sudden, a stock starts doing this. Chap, 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 chap. Nothing. Trading sideways. What I guarantee you will watch happen is an IV dump, because what's going to happen, right? Good options traders will know that sideways trading or choppy price action is typically not good to be holding a long call or a long put. So what will they do? They will sell, which inherently lowers demand, and there's less volatility, which is going to lower the overall implied volatility on that given ticker. So you will witness an IV dump. This is what I mean when I said earlier that options don't necessarily accrue value by simply seeing the stock price go up or the stock price go down. A stock can be trading sideways or even going up if you have a call, but if you have an IV dump, you can still lose money. That's a risk. That's an absolute risk. And these are things that we have to be aware of as we continue on. I bring up IV pump, IV dumps because Twitter is infamous for this. I've seen people, this is sort of a way you can protect yourself, by the way. I've seen people who will IV pump their followers. And what I mean by that is if you can't affect volatility, right? None of us as retail investors can affect volatility. The majority of the market's moved by whales. Majority of the market's moved by institutions, banks, whatever, market makers. But you can't affect demand. So if you see a guy on Twitter who is picking up a very low open interest call or put position, and they're pushing it on their Twitter, right? Don't buy it. They're IV pumping you, and what happens after a pump is you get fucking dumped. Do not follow people on Twitter who try to scam you for IV pumps. Don't do it. Now that you know what an IV pump is, now that you know how IV pumps happen, look for low open interest. If somebody's pumping something, they say, hey, buy this $10 call for XYZ stock. And then you look at the $10 call and it's got a total open interest of 2. Don't fucking buy it. That's not financial advice, but don't fucking buy it. You're getting scammed. All right? It's not a good idea. Avoid those things. Before we dive into the Greeks, I want to talk about historical volatility, and I actually have a chart up here that I find to be interesting. This is sort of a bonus if you want this extra information. Historical volatility using a website called Market Chameleon, which I actually have pulled up here. I'll also link this in the description box down below if you'd like it. It's free. All you have to do is create a username and log in. We'll show you the historic volatility, implied volatility of any given ticker. What I have pulled up right now here is Apple. You can see the historical implied volatility, or HIV, to take that for what it is, marked on a chart. It shows you dates. You can go all the way back to 8 April 2020, 8 April 2021, and it continues all the way up to present day. There's actually a strategy involved here in which you will see people try to just buy based on historically low implied volatility. So for example, if right now Apple's, and I'm going to draw this up on the chart that I've got pulled up. Let's say that right now Apple's volatility was actually about here, right? Instead of being way up here, we're going to pretend this isn't happening. It was way down here, right? Historically speaking, that is very low. And what typically happens when you see low historical implied volatility is decent sized moves back up, right? This is just sort of the ebbs and flow of the market. Nothing goes up forever. Nothing goes down forever. You typically have sort of a homeostasis in which the market always wants to kind of slingshot around. You can think of it as a slinky, you know? Energy just has to move from one side to the other. Something to pay attention to is historical volatility levels. And this is actually a way to know whether or not you're paying a lot for your contract compared to previous historical implied volatility. It's just a nice tool to have. I would recommend looking at it. There are some people who actually trade based just on this, just on how is the implied volatility now compared to how it's been for the previous year. And they'll just buy stuff based on that. And it's actually a pretty viable option if you're sort of a swing trader or a leap trader, which we'll get into as we continue on. But that's the piece on historical implied volatility and on implied volatility. Market makers, pay attention to this. We're going to dive into this more as we continue on through the video. But now let's get into the most confusing shit, the stuff that people hate learning the most, which is the Greeks. I am not even going to focus on Rho, right? I'm going to first off give you the book definitions because I think that's maybe important. And then we're going to dive into actually what the concepts are here because that is actually important, right? Delta, Gamma, Vega, Theta, Rho. You guys can read, right? I'm going to zoom in here. If you want to pause the video and read this, feel free to do so. I'm going to dumb it down. There's a much easier way to think of these than what is given by the book. I think if you look this up online, most of the time it's kind of confusing. These are what are the most important to me. And then sort of the number 4 is going to be Vega, right? I do look at Vega, but Delta, Gamma, Theta, by far the most important to me. Delta is great for hedging. Great to know for hedging. I think that Gamma is great for trades. I think that Theta is great for both. And we'll dive into sort of what this means as we continue on. Delta, right? Delta is how much you are going to make on your contract every time a stock goes up or down $1, right? Obviously, if you're playing a put, you want the stock to go down $1. You will make however much the delta is for that dollar move down. If a stock goes up $1, you're playing a long call. You will make that incremental value on that dollar move up. Let me show you an example quick. check this out. If I'm going to come over here to Apple and I look at the 172.5 calls for 14 April 2022, you're going to see delta. This is almost always going to be on your broker. You will always have access to this. You can see that it's at a value of 32.328. If there's 100 shares per contract, that means that you want to multiply this value by 100, which would mean that this is actually $32.80. So what does this mean? That means that if Apple's current price is $170 and it goes up $1 to $171, if you bought this contract at $1.18, you would actually make that extra 32 cents onto your contract. So let me draw this out and visualize this so that you can actually see it, right? Apple is trading at $170, right? This goes up $1. My contract, then my call, which was previously priced at $1.18 for the ask side, would then go up however much the delta was, right? And if the delta here is 32.8 cents, then I can add 32, right? Add that up, you get a 0, you carry the 1, you get a 5. Congratulations, now you're at $1.50. You made pretty good money. Maybe you have 20%. Not crazy, but that tells you how much you're actually making. That is the value that you make on any sort of move. Delta, there's another concept though that we need to sort of apply. And it's that it goes up and down depending on sort of risk, right? So when you're out the money on either a call or a put, you have the greatest risk and typically the lowest delta. The reason that people love to YOLO out the monies is because it hasn't been priced in yet. You're still in extrinsic value land, which I'd mentioned before. This brings me back to the extrinsic versus intrinsic value. If you're playing with extrinsic value, delta is going to be low. You're not going to make a lot for every dollar move. However, if you can get an out the money call to in the money, delta ramps the fuck up. When you buy an in the money call, it's already been priced for. You haven't gotten the gain of transitioning from out the money to in the money. That is sort of the risk, and that's why people take the risk, because you can make a shit ton of money if an out the money call or put runs to then in the money because it hasn't been priced yet. So low delta when it's out the money. Delta when it's at the money, which means it's at current stock price. The strike price is at stock price. It's usually at about 0.5. I'm just going to pull this up here really quick. Like for example, let's look at the SPY and we look at the at the monies for calls. You're going to see it's at 0.479, right? Typically it's at about 0.5, which means that every dollar move up, you will make about 50-ish cents per share, which is at about $50 on your contract, which means that this would go from 340 up to about 390-ish. When it's in the money, you can only go up to about 1. So if I'm at a call, you're going to notice that all the way super deep in the money down here, 99, 99, 99, 99, 99, 99, 99, it's about 99 cents and eventually taps at about 1. You can go all the way up to a 1 delta, which means that that contract is equivalent to 100 shares. That's what that means. Shares have a delta of 1 and contracts can reach a delta of 1, but very rarely will an out the money run in the money and you be able to capitalize on it. Most of the time you have to actually buy the in the money call or put to reach that delta. But that's the most simple way that I can put it. And if there's an analogy that I've got, D for delta stands for big dick gains. I think that's the easiest way you can think of it. Gamma, G, stands for give me more delta, bitch. That is the easiest way to think of this. This is a metric that tells you how much delta changes per $1 move. So if delta increases as it runs, further in the money, whatever, for either a call or for a put, gamma is the metric that's telling you how much it's changing until it maxes out at that value of 1, if that's to be the case. So in this example, let's come back to Apple. We can see that the delta for the 14 Aprils right now is 32.8, right? 0.328. The gamma, which tells you how much that delta will go up, how much more you will make. This is what I was mentioning before about out the money being sort of the favorite YOLO thing, because this is how you make a shit ton of money. The gamma is telling you how much that'll go up. This delta will go up every time that Apple goes up $1. So now let's say, we come back to this and we look at the fact that the gamma for this strike is 6.7, right? It's 0.067. And we look at our previous example, right? If the call goes this way, Apple goes up $1, it's now trading at $171. what is going to happen if no other metrics change, which is the implied volatility, theta decay, this and that, whatever, which we're going to get into more. What you're going to notice is that the next time around, you have to actually add that gamma to the delta. It'll obviously price this in for you, but this is just telling you what you can expect. So the next time around, your $1.50 contract will not go up by 0.32. It will go up by 0.38, which means that if it ran up to $172, your contract is now worth this. You've already almost doubled up on a 2-point move, on a $2 move. You can see how there's insane leveraging ability based on calls and puts. I mean, there's a lot. You can make a lot of money. It's nuts. You went from $1.18 to $1.88 on your contract off of a $2 move. G for gamma stands for give me more delta, bitch. Delta makes you the money. Gamma tells you how much more money you can make. That's the most easy way that I can put it. Theta. This is everyone's worst enemy outside of IV crush, which is what we mentioned before. T for that's not the fun part, man. Theta sucks. This is how much extrinsic value you lose per day. Remember we mentioned before extrinsic value representing time? So if time is passing, theta equals time. And it gives you a metric for that. So if we come over to Webull and we were to look at the theta as is right now, we look at the exact same strike. The 14 April 2022 is the 172.5s. What you're going to see is that it has a theta of negative 0.1664, meaning that for the current time being, every single day that passes until expiration, you have to subtract 16.6 cents per share, which is $16.64 in total per day off the top from this grand total right here at $118, right? Not fun. That's where risk tolerance is huge. Having a plan is going to be huge. So let's say that you made good money, right? You're up, it ran 2 strikes up, right? You hold this overnight and the price stays the exact same. Stays $172 into the open. What you're going to see is that theta is going to play a role now. Theta is going to subtract that value. So we come back and we look at that value. That value is presently 16 in total. You subtract about 16 cents. That leaves you with $1.72. You're still up. However, since time has passed, you lose extrinsic value. Options are priced on both extrinsic and intrinsic value. Intrinsic value is the right to exercise, which we will dive into as we continue on. The extrinsic value is time. Theta sucks. Theta will lose you money if you're not careful. Theta is definitely something to watch for. I find this to be very huge. Not very applicable for scalps. I think if you're going to get in and out of stuff in the same day, typically you're not paying too much attention to theta. I mean, if you're swinging it the entire day, you certainly should, especially if it's same day expiration. However, theta is more useful for sort of swings and for leaps. I'd pay more attention to it at that point. Brings me to the next thing. Vega. Not going to talk about row. Vega is how IV percent change will affect price. Now, remember I said there were 2 key factors that kind of price in options, right? You've got IVs, which is the implied volatility. You've got the Greeks. Vega will measure the IV percent change and how that will affect price. You can think of this essentially as IV crush or IV pump, pushing the price of the contract down or up. An IV crush obviously is down, an IV pump would be up. Webull does not use Vega, right? This isn't a metric that Webull typically uses, but if you were to look at Vega as it is, it's going to tell you based on a 1% IV change how much the contract will either go up or down, right? So for an example, let's say that the Vega for these same contracts is as is, and we pull up, the implied volatility for this is currently 24.56%. Let's say that the implied volatility goes from 24% to 25. If the Vega value, we're just going to make up a random ass number, is 0.10, that would mean by the stock literally doing nothing, staying flat, not going up in value, not going down in price, whatever. If the implied volatility so much as changes, you would actually gain 10 cents. Congratulations. You'd be at 2, 8, 1, a buck. That's a fucked up looking too. You'd be at $1.82. But then if the Vega value is 0.10 and it goes down to 23%, you would then lose that 10. You'd lose 0.10. So you'd subtract it, you change this 8 to a 6. Vega represents IV pump and IV dump. It's an important metric to keep track of. I personally, my trading strategy is a scalper. So unless I'm getting into something that's super flat or has gone through an insane rip and then I'm trying to buy at the top, which you typically don't want to do, right? You're not really I'm not paying too much attention to this. I think this is more useful for swings, or if you're going to be scalping something that lasts a half hour to an hour and a half, you want to pay really damn close attention to Vega. That's an important metric at that point in time. But it's probably out of those four things, what I pay attention to the least personally. That may be right, that may be wrong. That's just what I personally do. You have to decide for yourself. I'm here to tell you what I think is important information for you to make up your own mind and learn some more. Row, I don't really use it. You know, I'm going to be straight with you. But if you want to know what it is, it measures change in option price when stock price moves. Basically, you can look at the gamma and the delta, and this is going to tell you how much the options price actually going to change anyways. I think row is a metric not really worth going over. But if all this went over your head, you've watched this 2, 3, 4, 5 times through, you don't want to pay attention to it, there is always the handy dandy cheat code. Remember when everyone was playing Grand Theft Auto San Andreas and you had your fucking notebook of cheat codes? Well, guess what? They've got one for you. It's the Options Profit Calculator. I'm going to link it in the description box down below. What you can do is go over here to the Options Profit Calculator and click on whatever you want. You can go basic, you can go spreads, you can go advanced. You can dive into all these different things. For example, if I want a long call and I want to know how things are going to change in price, I type in Apple. You then go over here to your option, which we were picking the 14 April 172.5s, right? You make sure that the implied volatility is matched up by going to more output options. You want to look at all the different metrics that are sort of measuring this. So you can see the price per option. That's good. One contract. You can go to manual settings, call or put. Strike price, implied volatility is auto, but if you want to enter that, you sure can. And then you can just calculate. And it's going to tell you up until expiration day what it will look like for you to make or to lose money based on all the Greeks and based on implied volatility, as it is right now. This will also adjust if implied volatility adjusts. It'll also adjust as Greeks adjust. Sometimes it's off, but you can always manually update this stuff if you'd like to. This is what I usually use. I usually will eyeball the Greeks and I'll think in my head about, oh yeah, this makes sense. This looks pretty good. I'll look at the IV, I'll say this looks decently cheap. I'm not mad buying this right now compared to the historical volatility. I'll buy it and then I keep track of it by using the Options Profit Calculator. It's a nice tool to have. If you'd like to use that, feel free to do so. And that is sort of the big thing on the Greeks and implied volatility. If you got through that, you understand that. Good fucking job, because that is a complex topic. It's tough to learn, and that is, in my opinion, what is sort of the biggest barrier on getting people to want to know options, because it just fucking sucks to learn. But if you know it now, man, I'm proud of you. Congratulations. Let's move on to the last sort of piece of this, which is call and put pricing difference. Now, this is actually a fascinating thing, and this comes into what I mentioned before on historical volatility. And then the last sort of thing I'll talk about is the bid and ask spread, which is over here. But sometimes calls and puts will be more expensive than their counterparts. A beautiful example of this is actually AMC. And I've made it a point to not be biased and use AMC as examples on anything throughout this video. But this is a beautiful example. So if you were to look at this right now, you're to look at the 14 April calls for AMC, which is half a strike out the money, right? What you're going to notice is that it is $1.05. This is 25 cents away from running in the money, which would be the exact same as 25 cents away for a put to run in the money. What you will notice is that calls are $1.05. But puts are $1.02. What this inherently is telling you, since calls are more expensive than puts, and believe me when I say this used to be drastically worse, there was like a 50-cent difference between calls and puts, is that there is inherently more demand for calls. I say this because you can actually look at any ticker across the entire market, and if you see a large discrepancy between calls and puts, we have to think about what market makers are likely going to do, and that is collect premiums. Remember, we talked about earlier, this is why I kind of laid the groundwork out of what market makers do. Market makers want to collect premium. They don't favor a side. They don't give a fuck. They make money on both sides, up and down. That's their job. They have to. They have to do that, right? So if you see a pricing difference, it means that there's more demand inherently for either a call or for a put. Typically, if there's more demand for a call and the pricing is more expensive for a call, you will actually see the stock price go down. Now, I know that sounds counterintuitive, and there's a lot of different things you have to pay attention to in terms of like historical flow. Unusual Whales is a great resource. You have to look at historical implied volatility. But as a whole, market makers want to profit. They want to sell calls and collect premium. So if there's a whole bunch of open interest, there's a whole bunch of demand, people are willing to pay the price, typically market makers want to collect that premium. What happens when they collect that premium? You see a stock price go down. The exact opposite thing were to happen, puts are more expensive than a call is, what you will notice happen is the exact opposite. Market makers are going to look at this, they're going to say, oh, baby, that sweet, sweet nectar nipple milk of fucking premium, baby. They're going to want to take it. They want to take it. They want as many puts to expire worthless as possible so they can collect that premium. So if there's more cost associated to a put, typically, you will see stock price go up. That sounds fucking wild. I know that's wild, but if you think about it from the perspective of a market maker who can hedge and unhedge and buy and sell stock depending on whatever sort of orders are coming in, like I mentioned before, don't get me into the ethics of market makers. There's a lot of crooked shit that I think happens, but ultimately they run the market, man. They just want to make money. Where are they going to make the most money? That is the question that you should ask yourself. And this is actually a strategy you can use for any stock across the entire derivatives market. Everything. If you see a large discrepancy in terms of range away from the first strike on a call and a put, you can bet which way the stock is actually going to move in a small to mid-term sort of perspective. So pay attention to that. It's an interesting strategy. I thought it was something worth mentioning because a week ago I got a lot of backlash from people that, I said I think the stock's going to sort of go down for a given ticker, It did, and it was based on this exact theory. So take that for what it is. If you want to use that, feel free. If not, feel free. We're chill regardless. The last thing I'm going to mention is the bid and ask spread. This is tying then into the strategy behind options. Let me take a quick sip of Coke. That was more like a gulp. All right, bid ask spread. I mentioned this before, but stocks also have this. Commons are what you can think of as stock. Options also have bid and ask spread. You buy on the ask, you sell on the bid. The difference between the bid and ask spread, options, market makers profit right off the top. So what does that mean then? If you lose that 3 cents between the ask of $18.50, $1.02 on the bid, $1.05 on the ask, you lose that 3 cents, market makers make it. What do you want to inherently do to keep the most amount of money possible? You want to find tickers with a very slim bid-ask spread. Because if you were to buy this, right off the bat, you're already down 3 cents on your contract if nothing happens. If you were to come over here and say there's Nikola, some random company, 39 cents, 38, that's a great bid-ask spread. It means there's a lot of demand, there's a lot of open interest, there's a lot of trading on this. It's very liquid. You're to come to the SPY, typically you have a decently low bid-ask spread, right? We're going to look at this real quick. 340, 338, 2 cent spread. Very nice. How you're going to know there's going to be a good bid-ask spread on anything is high liquidity. And what I mean by that, and I've got a algorithm in my Discord that'll ping off crossover alerts based on different things happening. If X, then Y. If X happens and Y happens, then this looks like a setup, whatever. But all of those tickers are based on one thing and one thing only: high liquidity. And what I mean by high liquidity is it is very actively traded. So if you think about that, what would that be? High liquidity stocks are typically blue chip stocks. The SPY, IWM, Triple Q, QQQ, Tesla, Nvidia, AMD, AMC, GameStop. Anything that sees a shit ton of volume all the time is always going to have a lower bid-ask spread. What is the reasoning behind this? Because there's more supply and demand inherently happening. If you think about basic economics and sort of the way that works, you have to change pricing depending on how much supply and how much demand there is. If there's a lot of supply and demand, there's going to be people willing to pay different prices for different products, for different supply, for different demand. There's just more market happening, right? When there's less market happening, you're going to have a wider bid-ask spread. If there's less liquidity, if there's less market, if there's less supply, there's less demand, right? There's less opportunity for price discovery. That's the easiest way that I think I can put it. So you want to look for high liquidity stocks for a low bid-ask spread. For most penny stocks, typically you have a large bid-ask spread. I think I've showed this before. I'm just going to pull up some random fucking stock Let's look at CEI. I don't know how liquid this is right now, but in the past, this has been very illiquid. Yeah, and what you're going to notice is exactly what I just mentioned. 14 Aprils, 3 cents and 2 cents. 2 cent, 1 cent. You're down 50% right when you buy this. You're down 33% right when you buy this. You look at the 29 Aprils, you're going to see 9 cent, 8 cent, 6 cent, 5 cent. That doesn't sound like a lot, right? A penny, but if you think about it in terms of percentages, you're already down 10% right when you bought this. So you want to find for highly liquid tickers, and that is where you're going to find the best bid-ask spreads. And that is level 2 of the options course. We have gotten through, I would say, the hardest stuff. This is going to bring us into level 3 now, which is what you can see over here, long versus short. Now, this part, there's a lot of misconceptions about options, and I want to kill this right off the bat. Long represents buying. Short represents selling. So anytime you hear the word long, that means that you are long, you bought, you're not short on that given contract. If you sold it, that means that you are short. If you sell a call, you're actually short on a call. If you sell a put, you're actually short on a put. You have to think about options completely different from stock. They don't represent the same things. So I have drawn up here sort of a four-way chart. We're going to dive into the level 3 now, which is long versus short. These are sort of the most basic things that you need to understand if you want to start playing calls and puts. I've got short in one category here, long in another category over here. I'm going to highlight this just so it's a little bit easier to see. These are calls. These are calls. These are puts. These are puts, right? So what does it mean to be long on a call? It means you have the right to buy 100 shares per contract at your designated strike price. That is to be long on a call. You bought that call, which on the opposite side of the trade means that somebody sold a call. Sometimes this is market makers. Most of the time it is. Sometimes it's retail. Sometimes it's banks. Sometimes it's institutions, whatever. That could be anything. But the opposite side of that trade, if you were to sell that call, a covered call in this instance, to someone who wants to buy a call, that means you have the right to sell 100 shares per contract at the designated strike price. So if I was to say, buy, let's just say a $10 call on XYZ stock, right? And the price is currently at $9. It runs from out the money to in the money, meaning that $9, maybe it ends up at $13 by expiration day. I now have the right to buy 100 shares per contract. If I have one contract, that's 100 shares at the strike price. So even if it's trading at $13, I get to buy those 100 shares at $10. Brings me to the short side. On the short side of it, a covered call, sell to open, buy to close. These guys, if it runs in the money, guess what they have to do? They got to sell their shit. They got to sell it. They have the right to sell 100 shares per contract at strike price. So even though it's at $13, they have to sell it to you for 10. It's a great fucking deal. It's not bad, huh? Right? So if anything, the covered call over here being short, they just had to sell it for cheaper. You got to buy it for cheaper. They had to sell it for cheaper. That's the opposite side of the trade. If you think about it as a transaction instead of just something that floats off into the abyss, you're going to think about this in a different way. A long call is a right to buy 100 shares per contract at a strike price. A short call or a covered call is the right to sell 100 shares per contract at that strike price. Let's move on to puts. Puts are the opposite. You flip-flop. Puts are the right to sell 100 shares per contract at a designated strike price. We're going to use the same example. If you were long, right? A long put is the right to sell 100 shares per contract at your designated strike price. The opposite side of that, if you are short a put, a cash secured put, you have the right to buy 100 shares per contract at that designated strike price. So let's say that I buy an out the money put instead of a call, right? Let's say that the price of the stock is at $13 and then it runs down to $7, right? And I decide that I want to exercise extrinsic versus intrinsic value. As I mentioned before, intrinsic value is the opportunity to exercise. It's the true value of the contract, is the leverage behind it, the shares behind it. Now I have intrinsic value. I decide I want to exercise it, right? Let's just say that I'm going to do that. Then, if this ran from 13 to $7 and my strike price was a $10 put, guess what I get to do? I get to sell 100 shares per contract at the strike price of $10. What's the opposite side of that trade? The long call means that I bought that. The long put means I bought that put. The short put or the cash secured put then has to buy 100 shares per contract and give that to you to sell for $10, even if it's at $7. They have to buy this, even if it's trading at $7, right? Stock's trading at $7. They say, damn, I wish I could buy this for $7, but unfortunately I sold this cash secured put, so now I have to buy it for 10 instead of 7. They got to give that to you. You get to sell it for 10. They had to buy it for 10, even if the stock is trading at 7. That's the easiest way to think of it. Think of the opposite side of the trade every single time, and you're not going to get mixed up. There's always somebody on the opposite side of your transaction. Most of the time it's a market maker, but there's always an opposite side of your trade. And that's the way that you have to think about a long call or a long put, a short call, a short put. So let's crush some misconceptions before we continue on. Are long puts shorting a stock? No. A long put, the word long representing that you own a contract that has the right but not the obligation to sell stock at a designated stock price, is not shorting the stock. You are not borrowing shares to sell into the market. Those are shares that are therefore leveraged by a market maker to sell into the market if you desire to do so. Most of the time, people do not exercise their options. It can be very lucrative to simply sell them if you make a lot of money on a long call or a long put in this situation. So most of the time, people do that. How you can compare it to shorting, if you want to make any comparison, we'll get into this later, is gamma ramping. This is still not shorting though, right? Let's make this painfully clear. Puts are not shorting. Not even remotely. They're 1,000,000% not the same, not related. Puts are an opportunity to sell something for higher than the current strike price is at. You were just profiting, right? You're not shorting into the market. You're not borrowing stock to short into the market. You're taking profit. That's it. That's all that this is. Are covered calls and cash secured puts shorting / risky? Covered calls and cash secured puts you can think of, and I consider cash secured put to be a little more risky, but these are opportunity costs, right? So if I own a cash secured put, so I'm short on a call or I'm short on a put, right? Covered call, for example, we'll use this. If I'm going to sell one of these, it means that I have at least 100 shares per contract that I'm selling. If this is Apple, it means I own 100 shares of Apple. What this is if you are wrong and you have to, essentially give up your contract to this guy over here who was right and exercises, you have opportunity cost. You still made money on your shares, right? But you don't get to sell it at the peak. You don't get to sell it for whatever it's trading at. You have to sell it for the strike price of your covered call. Opportunity cost. These are actually great tools, and these are things that I think people use most often when they have a lot of money to work with. Because the returns aren't as nice. You don't make as much on a short call or a short put compared to a long call or a long put. Just because there's less risk associated. It's opportunity cost. There's not as high of a return. So therefore, if you're playing with a $100 account, you're making 5%, you made $5. Congrats. But if you're playing with $1 million account, you made 5%, you made 50 grand. I mean, that's a whole different ball game. So I think that covered calls, cash secured puts better for a larger account. However, if you want to practice good habit, it is certainly a good thing to do in the meantime, especially if you're just holding sort of a long-term investment that is range trading, whatever. We'll get into sort of strategies from there. And also, I've got a charting masterclass in the description box down below if you'd like to watch that as well. Do they affect price? They can, all right? There is a way that options, and as I mentioned before, if options represent, one contract represents 100 shares, that leverage can move price by market makers. Market makers can move price by doing something called delta hedging. Now, we mentioned delta before. I'm going to take out all the extra details. They want to manage the delta on their books, which just means they want to stay profitable, right? That brings me into gamma ramping. This is the misconception that we kind of have to talk about and how gamma ramping works for in the money, at the money, and out the money calls and puts, and then we'll show you a visualization. Do options affect price? Out the money when initially purchased? No. Out the money will not affect price even slightly right when you buy it. Right when you buy it, it has absolutely no effect on the price. None. At the money, can. Doesn't always. It depends a lot on expiration date, how far away you are from expiration, but these can affect price. The real beasts are when in the money contracts are either bought or out the money and at the money, then run to in the money. This is where you see hedging, because market makers have an obligation. Think of it this way, right? They have an obligation to always have supply available for demand if the demand is to actually ask for the supply. You can think of this as like if I'm a car dealership and I expect 100 people to come into my dealership, I better have maybe, I don't know, 500 cars available for those 100 people to look at. Because if I don't have that supply ready and 100 people come in and I'm fucked, well, then you're just fucked. I mean, you're screwed. You don't have the supply available for the demand. Does that mean that 100 people are going to come in? You know, sometimes you expect 100 people, but 20 come in. It makes sense, right? Then you don't have to worry about it. You can get rid of some cars, whatever. That's something market makers will also do that. But you always have to have the supply available or you can get dick slapped. And market makers will do that. And that is what gamma ramping is. So when an in the money call or put is purchased, what will happen is market makers will hedge the equivalent in shares. Let's say that there are 10,000 in the money calls bought. Well, you multiply 10,000 by 100. You add 2 zeros then. 10, 0, 0, 0, 0, 0. What you'll then see is market makers have to buy 1 million shares of stock by the off chance that these in the money contracts are exercised. That can move stock price up. In the exact same way that if 10,000 in the money puts are bought, they have to sell 1 million shares by the off chance that these get exercised, right? That can push stock price down. If out the money or in the money contracts then run in the money, those can get hedged for, either up or down. You can gamma squeeze in both directions. All right. That's actually important to know. And let me show you a visualization of this, right? So let's just say you can visualize this a lot of different ways. If there's a whole bunch of in the money contracts that are bought for $9, for example, out of nowhere, you just see a slap down of 10,000 $9 calls. $9 calls. Market makers got a hedge for that. They push it up. And then all of a sudden, if you have open interest on out the money calls, let's just say 10,000 here, 10,000 here, 10,000 here, and it starts running, you can experience what's called a gamma ramp, in which these $9 calls getting hedged for by market makers. Remember, 10,000 contracts represents 1 million shares. The buying pressure of that can actually run price of a stock then for a contract from out the money to in the money, and market makers can have to buy this. A picture perfect example, if you'd like to see it, none other than GME, GameStop. I mean, GameStop is literally the best example of an absolutely monstrous gamma ramp. It's how this stock was able to go to $500 without a shadow of a doubt. The move from $5 to $500 happened because of gamma ramping. A shit ton of likely in the money calls were purchased. Those got hedged for by market makers, and it pushed the price up, which then ran out the money calls to in the money. Those get hedged for, and it's just a ball that rolls down the hill, gets bigger and bigger and bigger and bigger as momentum continues on. There's other examples, right? I think it happened with AMC, you know, another good example, up to $72. That moved to 72. Gamma ramp, without a shadow of a doubt. You look at SPRT, back before it became GREE, gamma ramp. This is a picture perfect. I didn't click on the right one. This is a picture perfect example of a gamma ramp move. In the money calls were likely bought, hedged for, pushes up, out the money runs in the money, those get hedged for, and you just get a monstrous sort of move. This can also happen to the downside though. It can. That's without a shadow of a doubt. If a whole bunch of in the money puts are purchased, a whole bunch of them, you flip this, you flip the narrative, right? Stock price is currently trading at $12, and then all of a sudden you get 10,000 $13 puts, which are in the money, that are bought. And they have to sell 1 million shares because 10,000 times 100 equals 1 mil, right? That could cause, if there's a whole bunch of out the money open interest at 12, 11, 10, 9, some form of a gamma ramp down. You can get that same exact sort of move. And I think you've actually seen that before with other stocks. I mean, you look at SPRT. This is actually a gamma ramp down. I am willing to bet you money, without a shadow of a doubt. What likely happened is people sold their calls, which means that market makers can unhedge because they're no longer obligated, right? We made that example with the car dealership. Unhedged for that. Whole bunch of puts were probably slammed in the money or out the money, and it ramped down. You probably saw it with GameStop. A stock doesn't go from 500 bucks all the way down to 40 naturally. All right. It doesn't happen. It happens by gamma ramping and by market makers wanting to collect premium. There's sort of a back and forth that happens here, right? Market makers are a much bigger piece of this than I lead on, but I have 2 half-hour-long videos that go through that if you want to check this out. But gamma ramping was certainly a piece of this too. The move down from 500 all the way to 40, gamma ramp down. I mean, it goes both directions. We have to accept that for what it is. Stocks will never go up forever. They will never go down forever. They always ebb and flow, just like this. Sometimes the moves are really fucking extreme in either direction, but they're always going to keep riding the wave, up and down, up and down, up and down. And that's because of a mechanic like this. You can gamma ramp in both ways, up and down, and that is definitely the absolute truth here. And I want to be able to pitch this to you. Max Payne. Let's briefly touch on Max Payne, and then we're almost done with this course. We'll be able to move on with our day. Max Payne for calls and puts. The way that you can think of this actually ties in pretty decently with what I mentioned before about mispricing, right? So if you want to look at mispricing on different calls and puts, if a call is more expensive than a put, you're going to see Max Payne favoring calls, which means for Tesla, for example, there was a Max Payne of $980. So what does that mean? If that's below the current stock price, it's not above the current stock price, and it's pretty decently below. There's 2 sort of, probabilities here. If you look at Tesla right now, either A, the Max Payne was for calls and market makers lost a lot of money, right? Or B, it was for puts and puts lost a lot of money. Regardless, Max Payne is a value which can tell you where you can expect some sort of hesitation for a number not to quite be hit. If I had to take a stab at it, it was likely puts. Puts likely got smoked. There's probably a whole bunch of put premium getting slapped into Tesla because the market had a shit week, and they ran out of luck. I mean, the Max Payne was 980. Didn't get the hit. They lost some money there. Didn't quite get to happen. So you can actually watch Max Payne and use this as a strategy to sort of watch, because this is market maker land. They love this shit. They love Max Payne. That's where they make the most money. Think of Max Payne as most profitability for a market maker collecting premiums, right? If you watch Max Payne on any trade that you're trying to take, especially if you're swinging, but sometimes in scalps scenarios too, you'll actually have a pretty good idea of when you should just fucking get out. Because Max Payne sucks. Most of the time, Max Payne, you lose. Doesn't always happen that way, but most of the time, Max Payne, you're going to lose. If the stock is in this price range, you should expect something called price pinning. It sounds like it's illegal, but believe me, for some reason it's not. Price pinning will happen at Max Payne, in which case stocks will start trading like this. Flatline. You look like your fucking grandma just died in the ER, no movement whatsoever. Price pinning can happen at Max Payne, so watch that. I want to bring that up because it's an important thing. It happens for both calls and for puts. You want to watch these. You want to see which way it's sort of favoring. If it's below or above current stock price, you kind of have an idea at that point. But that's another strategy that you can use, which brings me into the final piece. We've almost graduated the options masterclass strategy. Now, I'm going to go over what I find to be the most important basic strategies. And what I mean by this is long calls, long puts, sell calls, sell puts, which are known as short, and then a long strangle, right? There's many more. There's a lot of option strategies. Some are complexities over even my head, and I'm going to be straight with you. There's a lot of ways you can play options. You can think about it, right? If you've got 4 different things you can do: long call, long put, short call, short put. You multiply all the probabilities. There's a lot of probabilities. There's a lot of ways you can miss and match and do all this and that. But I like to keep it simple. These are my favorites. There are many more. If you want to dive into more, that's on you. Long calls. Situation in which you are betting that the stock price goes up. Risk tolerance is always huge. You want to make sure that you're not over leveraging a portfolio. And for both of these, my rule of thumb is 10%. Now, what do I mean by this? If I have a portfolio of $100, I would never want to take a long call or a long put trade or hedge. Hedge a little bit different, right? But a trade more than $10. 10% of 100 is $10. You're not going to get emotional. You're protecting yourself. It's a way of protecting risk, right? I will never take a trade larger than 10% of my overall portfolio in any long call or long put. I think that's drastically important to know so that you can avoid situations like this, all right? Trey back here. Trey back here wasn't doing the 10% rule. Trey back here was putting a little more money than 10% into that trade. All right, don't lose money. Avoid that. That's not what you want to do. That's my rule of thumb. You can come up with your own, obviously, but I'm just putting the idea out there so that you can protect yourself from risk, right? Long call, long put, we spent a lot of time going over. Selling calls, selling puts. If you want to go over that again, go back to it. But I find these to be the most useful for two sort of things, right? If you want to hedge a position, I never short things, all right? So I've never shorted a stock. I don't want to short a stock. It's not of interest to me. So if I'm to hedge a position, I would do it with a long put. And what I'm looking for is if I have 100 shares in any stock, I want to hedge with at least one put contract. That would be the strategy for a hedge. Every 100 shares, I will hedge with one put. That's my ratio. And remember, puts, calls, derivatives are much cheaper than shares. My 100 shares of any stock going to cost way more than that put contract insurance policy. Think of it as insurance. If you want to hedge and protect yourself from the downside, I personally prefer to buy it in the money. All right. You don't want to, because you're not trading. You're not trading. Remember that. You're not trading. You're trying to protect yourself from risk, which means that true, you won't make as much if the stock price goes down, but you don't want it to go down anyway, right? This is insurance. This is a worst case scenario. I have this insurance plan. I'm able to make money on my investment. Why in the money? Remember before that I said that delta goes up as you get deeper in the money? You want to get as close to possible of a delta of 1, because I said that shares are a delta of 1, which means if you got real damn close to a delta of 1 on your put contract, you're actually going to be matched pretty damn well on your shares, right? Meaning you won't lose money. You'll make money. You would make money, or you'd be down on your shares. You'd be up on your put contract. And when you think it's at a bottom, you sell your put. You can actually buy more shares for when the stock price goes up. Fantastic, huh? That'd be a strategy for a hedge. I don't typically hedge for calls, but if you short stocks, you do the exact opposite thing for calls. If I was short 100 shares, I'd want to find a call with a delta close to 1 to match with my overall short position. I usually trade long calls, long puts. I follow the 10% rule, no more than 10% of my portfolio in any given trade. And then I'd follow sort of this risk tolerance over here. Plan. I always have a plan for an entry. Technical analysis, charting. I'm not going to dive into that right now. Go to my charting masterclass if you want to watch that. I always have a stop loss. You decide this for yourself. My stop loss, because I usually scalp, is between 10 and 15%. I always slim my position, meaning that I take profit as it goes up. And then I have a plan for a full exit. What specific level am I watching for either the upside or the downside to fully exit my position on a trade, right? Want to bring that up right now. Covered calls, cash secured puts, selling, right? If you want to do this is more of sort of a collect as you go. You know, you're a long-term bull or a long-term bear. You're just trying to make money as things kind of go whatever direction they're going to. I typically don't do this. Like I said before, this is kind of a nickel and dime scheme. If you're very satisfied making small percentage gains every week, could be 3 to 5%. That's pretty typical. 3 to 5% gain on a short call or a short put. That's not bad. You're doing pretty well, but you are capped. You're never going to make more than whatever the premium is that you're selling it for, right? That doesn't really change. So that's a strategy for long-term investments that you can kind of just collect while things aren't quite going the direction that you think they are. Just remember that there is that opportunity cost associated if you are wrong, and you have to then give that contract up to whoever bought it, right? Long strangles. I have a physical representation of this. Check this out. A long strangle, I think the perfect sort of opportunity for this is earnings season. If you're playing earnings and you don't know which way the stock's going to go, you don't know if it's going to go up, you don't know if it's going to go down, but you know that it's going to be extremely volatile in either direction, a long strangle is a great opportunity for you. And what this would be is one out the money call and one out the money put. You pair them, meaning that whichever way it goes, all that you need is a lot of volatility and you're going to make money. When you don't make money on a long strangle is when it's not volatile. If earnings is flat, price doesn't move, you lose. That's what it is. You win regardless, as long as it's volatile in either direction. That's what you personally want to see in a long strangle. You can actually lean them one way or the other, right? Let's say that I think it's going to be more bullish than bearish. You think the price is going to go higher, right? I can actually pair it so that I've got like, I don't know, 10 calls. Then as insurance, I've got 3 puts. So that if, I'm wrong, if my bullish sort of scenario doesn't come to fruition, I hedged it with the 3 puts. And then maybe you'll make money if it's extremely volatile to the downside, but at the very least, you'll come close to break even, A lot of different ways you can play that. I think it's great for earnings season. I think it's great for just volatility in general. You can play it either way. Just keep in mind, IV crush. Typically going into earnings season, you're going to see that IVs are going to be at really, really high levels. And after earnings comes, if you think about this, psych speaking from a market maker perspective, market makers will have high IV because they expect more volatility, right? Earnings will bring about high volatility. They price that in beforehand. And then after earnings is over, they will usually dump it. So keep that in the back of your mind. You usually need a lot of volatility going into earnings. I think they're more risky than not. I usually don't play earnings for that exact reason. I don't like the risk. But that is also a strategy. So looking at all these things, looking at long calls, long puts, short calls, short puts, long strangles, what are the 3 things that I think you can kind of do? And then what are the factors to consider in choosing your own strategy? Scalps, which would be day trading. This is intraday stuff, in and out, sometimes in 5 minutes, sometimes in a few hours. Swings, anything that you hold overnight for up to a month, 2 months, 3 months, whatever. Leveraged investments, which are leaps. These are things that you would hold for years. This is what Nancy Pelosi kind of does. The great goddess, the goddamn Aphrodite herself, the greatest investor of our time. Don't you dare say she insider trades. Leverage investments are leaps, right? Essentially what you're doing is you want a little more bang for your buck. You're buying probably in the money, calls or puts, in whatever direction you think it's going to go for a good year, 2, 3 years out, whatever. Factors to consider when you choose what strategy works for you. Time. Do you want to battle theta? That's a huge question you need to ask yourself. And specifically speaking, do you think you will have the discipline for day trading or swing trading? Because it takes a lot. Some days you're going to be wrong. Some days you're going to get kicked in the dick. Some days your ego is going to get crushed. And you have to be able to just look yourself in the mirror and say, I was wrong. That's okay. Let's get back to the plate. Because if you can view it that way and look at a trade as a statistic, out of 100 trades, how many of these are going to be profitable? Instead of, I want to make $1 million on this trade, I think that scalping and swing trading will be good for you. It's up to you, though, right? You got to do what you got to do. Time allotment. Do you work a full-time job? Do you work a 9 to 5? Do you really have the time to be sitting down and looking at a chart for an hour a day? Right? Because you're going to have to plan out. You're going to have to find setups. You're going to have to see what makes sense to you. Remember what I said that trading is hard, trading is difficult. You have to put in the time if you want to learn. You're going to have to put in the time if you want to make money. I think that's true. I really do. Time allotment's huge. Think about that. Are you a fundamental or are you a technical investor? Do you find yourself understanding fundamental analysis more so than technical analysis? Do you read charts better than you're able to read balance sheets? Then you're better to sort of conceptualize the intangible parts of a company that make that company stand out, right? Could you have predicted Tesla when it was a $50 stock that Elon Musk would bring it where it is? It's just a different sort of mannerisms, right? What do you feel is your strength? If you are a technical guy, you like looking at charts, you like analyzing charts, scalping and swinging is more up your alley. If you're a fundamental guy, right, you like looking at charts, you don't like looking at charts, you like to analyze companies, intangible and tangible things, such as who manages the company, balance sheets, cash flow, investments, whatever, right? You're probably looking more towards a leap. That's more up your alley. I'm a scalper and a swinger. That's more my thing, especially lately scalping. I really don't like swinging because of how volatile the market is, and I don't like the risk of overnighting a position. Because keep in the back of your mind, one thing I haven't mentioned yet is that you cannot buy or sell options during the pre-market or after hours. Extended hours, off limits. Can't touch them. It's very important to know. So a scalp, shortest expiration possible. These are the things that I'm looking for, all right? I want the shortest expiration possible. The reasoning behind that is because I'm not sweating time. Time is not a factor here. Because what I'm doing is I'm looking for a setup in an exact moment. I'm executing it, and then I'm getting out immediately after. Time is risk. And if there's no time, you already see the setup there, then there's no risk. For example, what I've got drawn up here is a chart. This is Twitter. Falling wedge setup, right? I've got a charting masterclass like I mentioned before. Go check it out. Descending level of resistance, descending level of support, breaks out. I would take an entry here. Once I start seeing this chop sideways, maybe even here, right? 5-10% gain, you exit. You can get out here. You can get out here. As long as it moves up in the direction you want, you take that long call. You exit that long call. I'm just taking it right there. I'm not worried about time because the setup's right in front of my face, right? Shortest expiration possible, usually about one strike out the money or at the money or what I'd personally be looking at. You need high discipline. You have to have a risk and reward plan, and you want to take small size. I usually take, like I said, no larger than 10% of my overall port, but typically I'm leaning tight, like towards that 3 to 5. 3 to 5% of my port is what I'll take. I'll take 10% for a very high confidence trade. 1 to 5 minute time frame. Those are the candles that I typically would use for these sort of setups, and that would be my advice if I was to give it. But ultimately, that's up to you. Swings. These, like I mentioned before, are like couple weeks, couple days, couple months. You always want to give yourself extra time and accept less risk. Here's an example. If I think Tesla as a put position, right, will hit $1,000 by June 1st, right now it's trading at, let's just look at what it's at right now, 1,025, right? If I think it's going to hit 1,000 by June 1st, I am going to give myself less risk on the strike and less risk on expiration. I'm going to buy the extra time and I'm going to buy the less risky strike. So if I think it's going to hit $1,000 by June 1st, myself for a swing, I would buy a long put for 1 to 2 months later. So in this instance, maybe like 15 July, and I'd buy the 1,050 puts in the money. That's what I would do because time equals risk. Lots of things can get fucked up. Lots of things can go wrong when there's more time on the table. This is much different than a scalp, right? If I'm on a scalp and I see a breakout happen right there, bang, boom, boom, right? There's no risk. I know it's there. It just happened. I just have to take advantage of it. But time allows for risk, which means you want more time to combat the risk. You want it because a lot of things can happen between here and here. If one thing goes wrong between here and here and you didn't have the extra time spaced out, you can get dicked. You just don't want that. You don't want that for yourself. I think that it's important to have a mix of both technical analysis and fundamental analysis understanding if you are going to swing positions. Typically, people will swing based on news catalysts and that sort of thing. But ultimately, some people do just swing off TA. I personally don't, but that's up to you. Have a risk-reward plan. I personally follow these things: entry, stop loss, slimming, and full exit. And the time frame, 15-minute to 4-hour time frame. Don't watch the really short stuff. If you're watching 1-minute candles on a true swing, you're just gonna fuck yourself up. I mean, don't psych yourself out. Take it for what it should be, and that is a swing, which requires a different time frame to be watched. 15-minute to 4-hour. Leaps. This is a leveraged investment. It could be up, it could be down. You could be trying to take advantage of the upside or the downside. For example, if I think Tesla's going to go to $10,000 in 10 years, maybe I buy a call for $2,000 for 10 years from now, if that's even an option, right? You want a lot of time. Go as far out as you can, pay for the extra time, because all that this leap is doing for you is leveraging a little extra so you can make a little bit more as that stock goes up. In the same way that you can buy a leap if you think a company is fraudulent. If I think a company is fraudulent and I want to buy a put leap for a couple of years from now because I think eventually they're going to get bankrupted, right? Time is your ally. You want as much time as possible. Go far out, pay the extra insurance, whatever, because this is an investment. You are already going to be putting up the stock anyways, how much the stock would cost. All you're doing is leveraging maybe an extra 5 to 10%. These are typically in the money. You want to buy in the money for these or at the money. You don't typically go out the money. That's not very common. You're combating theta there. You don't really want to get screwed by theta there. This is more of like a leveraging tool. You're really just following trend. This is based on sort of fundamental analysis. Keep an R&R plan. I think that what I mentioned before still applies. Larger size than 10% is probably applicable here. However, full porting, I would never recommend. I mean, I come back to what I just showed you before with Wall Street Bets and the loss port. Don't put yourself in a bad shoe. The candles that I'd watch daily. I really wouldn't pay any attention to anything other than a daily candle here. I'd be checking in once every couple days or a week or so, because if this is based on fundamental analysis, charts don't always represent the fundamentals of a company. So you really just have to take your time with that. And that's sort of my opinion on different strategies. You can pair this with charting. You can pair this with a whole lot of different things. You're gonna have a pretty good idea of what you want to do. But congratulations. You have gotten through an hour, 38 and 34 second options masterclass. Whew. I hope you learned something. If you have any feedback, let me know in the comment section down below. But I think this is pretty good. I think we covered everything I wanted to do. I think I covered it pretty well. And that's about it. So, yeah. All right. I'm probably going to go get some grub. Catch you later. Peace.